Hi, in this video we'll be talking about how do you go about evaluating your fund's performance. So let's go into the mind map. Now the fund performance. Now if you're looking at your fund's performance, you cannot really judge the performance of the fund on a standalone basis. You need to compare that performance with something. Only then you can evaluate whether the fund has given a better return, or whether it's an average fund, or whether it has underperformed. So we'll be looking at the benchmark. Every fund, it's a mandate. Every fund would have a benchmark, and you can compare the fund's performance with that benchmark. So every fund has to beat the benchmark, right? And that's why the fund is actually that's why the fund manager is there, and that's why they're charging a fund management fees, because the idea is to perform better than the benchmark. Now if you look at some of the examples here, now let's look at let's say Reliance small cap fund. So this is the Reliance small cap fund, and it has given 15% kind of a return in last 5 years. Last 3 years has been 13%. Now we need to compare it with the benchmark, and this is the benchmark for it, S&P BSE small cap TRI, total return index. Now this fund has actually done better. When the market has not done well, it has fallen less, which is a great sign. And when the market has done well, it has clearly outperformed, right? In long period, it has given twice the return, which is phenomenal, right? So first is we would look at the benchmark, whether the fund that we have selected is beating the benchmark or not. And then we would also compare it with the peers, whether the peers are able to do much better job or not. So let's compare it with the peers now. Peer comparison. There you go. So Reliance small cap, and then you have Access, HDFC, L&T, emerging businesses fund, and SBI. So in 5 years return, this fund has done well, but SBI small cap has given better returns in 5 years. Even in 4 years, even in 3 years, there are few funds which have delivered better returns, right? Now, should you be chasing the highest return giving mutual fund? Ideally, you should not, because this would keep changing. Right now, you may have SBI as the top, in all these funds that we see here, but after a year, you'll have a different one at the top. So never go chasing the top performing, because this would keep changing. A year down the line, 2 years down the line, when you relook at it, I'm sure you would not find SBI small cap at the top, right? They just keep rotating. So you need to also evaluate the fund against the peers as well. In this case, this fund, if you want to zero down on Reliance small cap, then it has done fairly well. Now we can also look at the expense ratio. It is a bit on a higher side. Small cap, SBI small cap is again a bit on a higher side, but it's all comparable. There's not much of a difference, right? In fact, this, in overall scheme of things, this is on the lower end. Otherwise we have Access small cap, which is 2.67, then 2.38. This is closer to 2%. So it's comparable, and the kind of return that it has given is also quite satisfactory, right? So in case if you want to settle down with Reliance small cap fund, keeping other things in mind as well, which is the portfolio manager and the history of the portfolio manager, all that in mind, if it fits your investment style, you need to look at the objective as well, whether it matches your objective. If all that is okay, then this is not really a bad fund, because it has done in terms of return, it has done comparable job. Expense ratio is also on a lower side comparatively, and has delivered great returns, in fact, over a long period of time, and is done better than the benchmark. Now another aspect that you would need to look at is the time factor, right? You should not really be looking at a 3 months, 6 months period when you're trying to evaluate whether the fund that you want to invest in, right? So even while selecting the fund, we would not really look at the 1 year, 2 years, or maybe 3 months, 6 months performance, because in an equity fund that does not really matter. We're looking for long term. When we're looking at an equity fund, we're talking long term, and the minimum period that you should be looking at is not 1 year, it should be 3 to 5 years at least, right? Maybe 1 year period you can look that in case if the market went down, the small cap haven't performed well in last 1 year, did your fund fall less? That is something that you should be looking at. But if you're looking at the performance overall for an equity fund, you should be looking at 3 to 5 years ideally. Now you can also look at in case if it's a short-term fund, then you can look at the 1 year, 3 years performance. But for an equity, it has to be long-term. And as far as liquid fund is concerned, even if you're looking at a very short time frame, which is a month, 1 month, maybe a 1 week as well, that's okay, because in liquid fund we are looking to invest for very short period only. So there you can look at a week's performance or 1 month's performance. But normally if you're looking for wealth building and you're looking to select a fund, then it has to be 3 years, 5 years. That's what you should be looking at. Also, you should be looking at, is your fund doing better when the market is falling, right? So that's another aspect that you need to look at. So time factor is an important component, right? You should not be swayed by 1 year performance. It could be because of some companies which the fund manager has selected, which have suddenly started doing well, and it has outperformed in last 1 year. But that does not mean that you should not look at 3 to 5 years performance. So never get swayed by short-term performance. Look at long-term performance only. 3 to 5 years is an ideal time, because 3 to 5 years is a kind of a market cycle wherein the market will see ups and it'll see downs as well. So you'll get to evaluate the performance accordingly during this period. Now, another thing that normally people look at is they look at the highest performing, the fund which has given the highest return. Like we saw in SBI, it was giving 20%, which was great performance in 3 to 5 years time. However, it's not really desirable, and the reason for that is, if the fund is giving really high performance, returns which are outperforming by quite a distance, then that also means that the fund is taking aggressive positions. They are making you're taking more risk in order to deliver high returns, right? And if that is the case, then it can actually go against as well. So never just chase very high performance, and it's not always desirable. If your fund is able to beat the benchmark, if the fund is able to match the performance with the peers, that's a good enough fund, because as I mentioned, this would keep changing. The fund which is at the top right now would not be at the top 1 year, 2 years down the line. So always keep that in mind. And the last is mutual fund rating. So every fund would have a rating, and every website would have a rating of its own. Even Value Research have its own rating. Now they have rated this fund as 4-star, right? And if you look here, there are some 5-star funds as well. So they have mentioned, they have given 5-star rating to L&T Emerging Business and HDFC. So maybe as a rule, you can only select those funds which are 4 and 5-star rated. So these are few things that you need to keep in mind while selecting a fund, and also while evaluating the fund, right? So that completes our portfolio building, and how do you evaluate the performance. Next, we'll take a look at when to sell and when to buy mutual funds.